Most people pursue wealth but never stop to consider a basic question. Which one generates more money faster, owning land or investing in businesses? On the one hand, you have property, solid, real, and cherished for centuries. On the other hand, you have stocks, which are rapid, digital, and linked to global growth. Both can lead to financial freedom, but they work in very different ways, affecting how soon wealth develops. Assume two people start with the same capital on the same day. One invests money in a rental property in a growing urban region. The other buys stock in several high-performing corporations listed on a worldwide exchange. After a few years, both may be lucrative, but their wealth growth rates and structures will differ. Long-term appreciation, rental income, and loan leverage all contribute to the success of real estate. Before returns can begin, there are generally discussions, documentation, inspections, and maintenance to complete. Stocks are based on market demand, firm performance, reinvested earnings, and compounded growth in fields such as technology, energy, and healthcare. At first glance, both paths appear appealing. Property feels secure because it is tangible. Stocks are interesting because they can expand rapidly. However, underneath these surface sensations lies a deeper distinction: liquidity, scalability, entrance speed, and emotional strain. These hidden aspects impact how quickly wealth accumulates in real life. Some investors feel real estate is always safe, whilst others believe equities are too hazardous. The reality is more balanced. Each system encourages different behaviors and uniquely punishes impatience. If you found this breakdown beneficial and want clearer, basic explanations of money, investment, and wealth-building tactics, subscribe to our channel right away to avoid missing out on future insights that can influence your financial decisions. Real estate generates wealth through ownership and leverage. When you purchase real estate, you get ownership of a physical asset that has the potential to expand in value over time. Rental income can provide a consistent cash flow, particularly when housing demand is high. Investors also use borrowed funds to enhance their holdings, which can increase returns as the market rises. However, property investment is slow. Buying and selling take time, and transforming value into cash is not fast. Maintenance costs, taxes, vacancies, and geographical concerns can all impede profit growth. Even in strong markets, growth is typically steady rather than dramatic. Stocks function differently. They allow investors to start with small sums of money and receive immediate exposure to huge corporations. A person can create a diverse portfolio in minutes and change it at any moment. This flexibility enables a speedier response to market changes and faster reinvestment of profits. The main advantage of stocks is compounding. When dividends are reinvested and share prices rise, wealth increases exponentially over time. Companies grow globally, develop frequently, and generate earnings that contribute to shareholder wealth. This results in a system in which money can expand without physical management. However, stock prices are volatile. Prices fluctuate daily based on news, earnings releases, world events, and investor sentiment. Many people lose money not because stocks are terrible, but because emotions induce improper timing, buying high and selling low. When it comes to speed, stocks typically generate wealth faster in the early and middle stages of investing due to liquidity and compounding efficiency. Real estate tends to create wealth more slowly but steadily, particularly when kept long-term with high rental demand. Economic conditions also influence outcomes. Inflation can boost property values and rental rates, whilst technical advancement and innovation can propel stock markets upward. Neither asset performs optimally in all situations. So, which one will make you richer faster? Stocks typically have an edge in terms of speed since they allow for rapid entry, quick reinvestment, and scalable expansion with less capital. Real estate generates wealth more slowly, but when properly leveraged, it can become immensely strong over time. The truth is that equities frequently speed early-stage wealth creation, but real estate promotes long-term financial stability. Many seasoned investors eventually blend the two, rather than depending on one. However, the essential lesson is not to choose between them. It is about understanding how different systems generate wealth at varying rates. Once you grasp how money moves through assets, markets, and time, you can stop guessing and make informed financial decisions. Because, in the end, wealth is defined not by the asset you chose first, but by how consistently and intelligently you participate in the game.